Right now, while Wall Street celebrates what they call a soft landing, the services sector just sent a massive warning signal that could affect 138 million American jobs. And if you think this sounds familiar, you should, because we've seen this exact setup before, right before the 2008 financial crisis, which cost 4.6 million Americans their jobs. What's happening right now in the services sector should terrify anyone who remembers 2008. The Institute for Supply Management just released data showing that the services PMI overall dropped to exactly 50. The first time we've hit this danger zone since January 2010. This is the breakdown point between growth and contraction. And for 138 million Americans working in services, this represents 1 out of every 3 jobs in America. But here's what makes this even more alarming. The business activity index just slowed down. It crashed into the contraction territory at 49.9%, falling over 5 points in a single month. We haven't seen business activity this weak since the height of the pandemic in May 2020. And just like in 2008, manufacturing weakness is now spreading to services, creating the exact same economic dominoes that triggered the Great Recession. As usual, we're going to break it down in 4 key points. First, let's break down exactly what's happening and why this matters to your financial future. The services sector isn't just another piece of the economy. It is the economy. Service accounts for 77.6% of the US GDP, employing roughly about 138 million Americans. This means that 1 in 3 Americans depend on this sector for their livelihood. The September ISM Services report revealed multiple red flags. First of all, the overall index hit 50%, and that's down from 52% in August. But the real damage shows up in the components below. Business activity plunged to 49.9%. Anything below 50% is contraction territory. Employment stayed in contraction at 47.2% for the 4th straight month. New orders decelerated to just 50.4%, barely staying positive. Now, what does this mean in real terms? It means that companies are cutting hours, delaying hiring, and in some cases, they're starting to lay off people. The employment components tell us businesses can't afford to find qualified workers. But more importantly, they're not even trying to hire. That's a massive shift from the labor shortage narrative we heard just months ago. And here's the kicker. This is happening while prices are still rising. As you can see, the price paid index came in at 69.4%, meaning businesses are facing higher costs while demand is falling. That's a recipe for margin compression and more job cuts. We've mentioned the doom loop in multiple videos before. Job cuts spawn lower spending. Lower spending causes smaller margins causes more layoffs, and it feeds itself. Key point number 2, the 2008 parallel. If this pattern sounds familiar, it should. In 2008, we saw the exact same sequence. First, manufacturing led services into a decline. Their inventory started to build up. Exports outside of the US fell, and prices kept going up even though demand was going down. And the results was 4.6 million Americans losing their jobs. If we look at this chart, you can see after the dot-com bust, there was a massive decline to around 40%. In the 2007-2009 crisis, this fell below 40%. In the pandemic, it fell close to 42%. And now we've just broken into the 49.9%, close to going down from here. Now, we bounced off this line this whole year, but we can't keep doing that. Eventually, things will go down and get worse before they get better. Here's what happened then and what's happening now. First, the manufacturing employment starts to decline. We've already lost 33,000 manufacturing jobs this year. Second, services begin feeling the spillover effects because they drive 10 to 15% of their business for manufacturing clients. Last, the consumer confidence starts to really get bad. And as people see job losses around them, they start to feel insecure, leading to reduced spending. Now, if you've ever heard of the Richmond Federal Reserve, they studied the 2008 recession and found that even service industries with no direct connection to housing or finance eventually felt the impact through reduced business investments and consumer spending. That's exactly what we are seeing today. Manufacturing has been in contraction, and now services are following. Export orders are declining. Inventories are building up. And businesses are reporting they have too much inventory relative to demand. These are the exact warning signs that preceded the 2008 collapse. Key point number 3, consumer spending crisis. The consumer spending data makes the situation even more dangerous. PwC's 2025 holiday outlook shows consumers plan to cut spending by 5% this holiday season. This is the first significant decline since the pandemic. McKinsey's reports that 25% of consumers are already cutting back on spending, with 43% listing inflation as their top concern. This creates a vicious cycle that we've talked about a lot of times. Reduced consumer spending leads to lower business revenue, which leads to smaller margins. This leads businesses to cut hours or possibly do layoffs. And that leads to even less consumer spending. Now, Gen Z, typically the most optimistic spenders, plan to cut holiday budgets by 23%, according to recent surveys. The holiday season is critical because it typically accounts for a staggering 20 to 30% of all annual retail sales. If consumers follow through on their spending reduction plans, we could see massive layoffs in retail, hospitality, and related service industries starting in January of 2026. What makes this especially concerning is that unlike previous slowdowns, this one is hitting while inflation remains elevated. Families are being squeezed from both sides. There's rising costs and falling incomes. The result is rapid deterioration in consumer confidence and spending power. And like we said before, the US GDP is over 77% consumer spending. This alone should be terrifying. Key point number 4, the defensive positioning strategy. So what can you do to protect yourself? First, if you're seeing your hours are cut or you're worried about job security, make sure you start building cash reserves immediately. You should cut some of your non-essential expenses and mainly focus on necessities. This isn't the time for major purchases or taking on new debt. For investors, this is the time to shift towards defensive positioning. This means reducing exposure to consumer discretionary stocks, travel and hospitality companies, and businesses that depend on consumer spending. Instead, focus on consumer staples, utilities, healthcare, and companies with strong balance sheets and consistent cash flows. Essential services tend to be recession resistant. People still need healthcare, basic food items, and utilities even during economic downturns. Now, if we do enter a recession, the Federal Reserve, aka the Fed, will likely cut interest rates aggressively. And that should help stimulate the economy, but it's only delaying the inevitable. This might feel like another massive addition to the US national debt. Well, folks, the data is crystal clear. We're facing the same economic setup that preceded the 2008 recession. So you shouldn't wait for the mainstream media to catch up to what the economic indicators are already telling us. Because if you hear it on mainstream media, it's already too late. If you found this analysis valuable, hit the like button and subscribe for more market warnings and defensive strategies. And share this with loved ones or people who might need this information so they can start setting up their defensive strategies. The services sector stall is a massive red flag, and most investors are ignoring it. With 138 million jobs at risk and consumer spending declining, we could be looking at millions of Americans hitting the unemployment lines, while those who keep their jobs face significant hour reductions. The time to prepare is now, before this economic warning becomes tomorrow's headlines. Thanks for watching, and until next time, stay diversified, stay safe, and I'll catch you in the next video.